So the first thing I want to talk about is there's a lot of you out there that may be venture funded. There's a lot of people out there that are looking for investors, whether it's the Class A professional venture capitalists, typically out of Silicon Valley, Boston, one or two in Austin, things like that. Or if it was more smaller VCs, sort of in name, but not the large funds, or even small private equity firms that actually have a place that they invest in startups and early stage. Probably not pure startup in the private equity world. But anyway, what was very interesting is I've been looking at the quarter-to-quarter stuff, and I've been referencing our good friends at CB Insights. And by the way, they're not a sponsor, but I give them a lot of credit, and I thank them very much for these charts. There's a lot of information that's floating around out there, but what I want to have in your mind as you're building a business or you're doing things out there to build a business, there are things going on in venture that are worth looking at. So let's take a look at the first chart and let me know when they can see that first chart. Okay, they can see it?
Is it ready?
All right, so there's if you're in your car and you're driving, you're listening to this, I'm gonna walk you through this. And those of you that are watching on YouTube or Spotify video, you can see it. What we have here is a chart that in 2019, you know, we were doing about 7,500 deals per quarter on a global basis. And it was running about $66 billion plus or minus per quarter. So $66 billion is being invested in about 7,500 different transactions, which is early stage companies, mid stage. So this is all VC, not all startups. Some of these are 5-year-old late stage, and this is a Series C, D, E for those. And then what happened is toward the end of 2020, it started rocketing up. And in Q1 of 2021, takes a big jump, and the chart goes to 8,700 deals and over 140 billion. So let's point that out. From Q1 of 2020, 7,000 deals, 61 billion, to Q1 of 2021, we go to 8,700 deals and 140 billion. So the money doubled, and it was 33% increase in number of deals. That would keep surging all the way to Q4 of 2021 as there were 10,000 investments done and $181 billion that was invested. Now, let me tell you, when you make money cheap and you print money, what happens? It runs to the top of the chart. And here's what I mean by that. So I'm going to get to what's happening in venture, but first of all, I'm going to give you a little lesson here, and hopefully this is helpful. You give a bunch of Americans a bunch of stimulus checks, and they go out and buy stuff. So let's say they buy a car. Cars were expensive, couldn't get chips, maybe that's a bad example, but they buy a bunch of clothes. And let's say that clothing is a 15% profit at the bottom, just to talk about it. For every $1 billion that goes into clothing, that's 150 million in profit that ends up in the pockets of those companies. So when everybody says, whenever you throw stimulus money out, it runs to companies and then it lands on balance sheets, that's what they mean. That it runs out there because the public is out spending, getting the economy going. There's a good side to that, but then there's also a side that people are spending cheap money. But nonetheless, now you have, for every billion, let's say in clothing, 150 million ends up on balance sheets. Let's just say that for grins. So you can see what happens when a bunch of money comes into the system. It lubricates, it flows around, it gets to everybody. And in the chart, so even if you're driving and you're just listening here, you have Q4, suddenly you're at 10,000 deals, 10,000 companies receiving a round of financing, and $181 billion of represented that was invested. You take that back to Q4 of 19, 2 years early, and it was just under 60 billion and 7,000 deals. So the amount of money triples and the amount of deals up there goes up almost 50%. Then you go to Q1. Now things start to change in Q1 2022. This is 2022. So you go from 181 billion in Q4 of 21 to 151 billion Q1 of 22, 118 billion Q2, 81 billion, holy, and then 67 billion in Q4, and now Q1 of 23, only 58 billion was invested. And by the way, you take out Stripe that did a $6.5 billion deal, and you're down to about 51 billion, 52 billion, which is lower than it's been in 6 years, 7 years. And it's down quarter over quarter, and we're back down to 7,000 deals. So I want to talk about what this means for you. What this means for you is that if your company is out there raising venture and you're in a good space and you're hitting your numbers and you're getting your traction, and I'm going to take you through that in a minute, you are probably going to be okay because you're going to be one of those 7,000 deals that gets the funding. Point is, there was a lot of cheap deals that were done in 2021, which was a surge from 2020. So think about it. So global venture funding has now dipped back down to $58 billion in Q1, 13% drop quarter over quarter, and a massive drop from a year prior, and coming back to the level that it was back in 19 and ahead. Now then, what was really interesting is, global venture capital has dropped 22% when you take out Stripe. So the headlines say, oh, it's 13% down. Take out the 6.5 billion for Stripe, it's 22% down. So the deal activity has tumbled now 4 quarters in a row. And I think what is happening is the cheap money and the easy investments are going away the same way people have been talking about the cheap money in real estate, Austin, San Diego, and San Jose, where we have a lot of data out there that right now real estate pricing are dropping. They haven't crashed 50%, but they're dropping. So the cheap money effect is coming back. People say, well, wait a minute, now you're talking real estate, and you're missing out Florida. Florida has got so much demand from people moving in, and a lot of people don't want to sell their houses because they don't want to give up a 3%, 4% mortgage and then go have to get another house somewhere for a 6.5% mortgage. Today, still 6.5%. So even if I said, hey, Biz Doc babe, let's sell our house and make $2 million in equity and then go live somewhere else. Well, unless we downsize, we're going to end up with a larger expense on a mortgage for that part of that if we chose to have a mortgage on it. So that's the cheap money effect. So let's, even though I mentioned real estate, ignore Florida for a second, and let's take a look at the places where we've seen the cheap money effect. The cheap money effect appears to have come and gone through the venture capital system. See, the whole ecosystem is interrelated. So what you have now is if you're in a great space with a solid company, you're going to have a longer time to go find your next round of investment, and you're going to have to show better numbers, but you're still going to be able to get something done as long as you have high quality, you've got traction and all that. And I'm going to walk you through the filter we keep here at VIG as part of that. But I want to show you regions, because the international scene is what's really amazing. So you give me a thumbs up when they can see this. They can now see this? Great. So again, if you're driving, you can't see this, but this shows the difference in funding in major regions. So difference in the US is showing down, 1%, Q4 to Q1, but without that 6.5 billion from Stripe in there, that would be about 21% down. Asia, it's down 27%. Europe, down 12%. Latin America, it's down 54%. Africa, down 30%. So the emerging economies in Latin America, not emerging economies, there's some wonderful economies are down there, but some of the more emerging venture markets and venture, investment zones in Latin America, Africa, down 54%, down 30%, quarter over quarter. That's just quarter over quarter. So suddenly it does sound like we're talking about housing prices quarter over quarter at the end of 2008. So what is this saying? This is saying that the US is still the bellwether of venture investment. And it's probably here to stay. But what I think is really interesting with all this is it just really shows that the great companies are going to find it, and the companies that are not well sorted are going to have more difficulties finding it. Let's look at something else here, which I think is very interesting. Unicorns. Everybody says, hey, unicorns are going to be out there. You know, I want to be a unicorn. I want to build a unicorn. So many unicorns are built. And unicorn, of course, is a company that achieves a $1 billion in valuation, usually within 5 years or so before they're sold to somebody else. So they are a startup at some point in the life cycle that is now sitting on $1 billion in valuation. So if you look at the chart in 2020, this is what it looked like. Q1, 25 unicorns created. Q2, 27 unicorns created. Q3, 38 unicorns. Q4, 47 unicorns. That's 2020. Reading the numbers in case you're not able to look at the chart right now. 2021, Q1, 116 unicorns created. Q2, 148 unicorns created. Q3, 21, 135 unicorns created. Q4, 138 unicorns created. That's 2021. So there was 1, 2, 3, 4, 5, almost 600 unicorns created in 2021. About 575, under 600. But that's huge. Now go take a look at, go back to 2020. 2020, there was 130 unicorns created in 2020. Compare that. Now let's go to 2022. 127 in Q1, 88 in Q2, then 25 in Q3, 19 in Q4. What happened in Q2? The Fed started raising interest rates. The free printed money was coming to an end. And if you wanted to get money from the government to turn around and do something with, suddenly it was going to cost you real interest rates the way it had practically for the entire history of America till we got involved in ZIRP, Z-I-R-P, zero interest rate policy. Money for free. But look at what's happened, the printing of money and that big surge, with all that money out there, even though you had all that stuff going on with COVID, the number of unicorns. Now let's go take a look. This year, Q1, 13 unicorns were created, down 32% from Q4, down 90% from Q4 of 21. So the birth rate is amazing. And by the way, what's interesting, 4 of the 13 unicorns in Q1, so almost 25%, were, wait for it, what industry? Yell it out if you know. AI. That's it. AI. And Anthropic, Adept, Character.ai, and DeepL. All of those, went out. And by the way, Anthropic was US modeler. It's an AI model developer. So if you need AI to do something, they can build you models and then you use the engine. And Anthropic is a researcher and a model developer. They're at a $4.4 billion valuation. So that is a $4 billion unicorn that's been created, just one of the 13 that happened in Q1 of 2023. So what's really interesting is what happened in the rest of the world. Europe only saw 1 unicorn in Q1. Asia saw 2. Africa saw none. So the US is still the bellwether of technology, births, and investments. But this tells you that right now, AI is hot, and being a sketchy startup is not. So this is kind of a case study I'm taking you through here, what I'm really trying to do. So I want to thank CB Insights for the charts and for all the great work, because this is really helpful stuff. I hope you found it helpful. If you got questions about it, throw it in the super chat. And a little bit later here, about the 45-minute mark, we're going to go to a couple questions and see if we can talk to you about it.